Hi, everyone. Welcome to the August 2025 edition of Student of the Market. At THG Retirement Solutions, we break down the noise. We provide a clear monthly snapshot of what's going on in the market so that you can stay informed and focus on what matters most to you. Last month, I told you how US stocks had the best May to June since 1950. Well, we are still looking at the fourth best May to July stretch at 14.2% for the S&P 500. Even though the S&P 500 has been strong, international stocks are still leading for the year, while bonds have posted only modest gains. Historically, when US stocks perform well, the rest of the year tends to follow suit. As you will see in the chart, May to July time periods, the following 5 months, August through December, 8 of the 9 have positive returns. Volatility proves that it is unpredictable. As you will see, there has been many time periods over the last several years where the market is up or down 2% in a given day. This year, that's already happened 12 times through July 31st. This volatility leads to mistakes and will erode investment results. As you will see, bad investments can cause a lower return for a personal portfolio. Shelter inflation makes up the largest portion of CPI and is slowly heading slower. As you will see on that chart on the left, it has been lagging behind CPI the last couple years. But previously, CPI has outpaced shelter inflation. So what does that really mean? As shelter costs ease, maybe that should help offset the rising prices in other categories like food and transportation. This could support the Fed's efforts to manage inflation without aggressive rate cuts. The Fed funds rate remains above inflation currently through June of 2025. Fed funds rate is at 4.3 at this time and inflation at 2.7, which is a difference of 1.6%. Historically, when rates exceed inflation by at least 0.5%, both stocks and bonds have performed well. This gap has been a tailwind for markets. The Fed paused rate cuts in December of 2024. Historically, these pauses don't last long, typically just a few months, as you will see in this chart. We are now several months in, and the assumption is that another rate cut is coming. And when rate cuts resume, both stocks and bonds have tended to perform well the following year. It's definitely something that we're keeping a close eye on for the second half of this year. It is very important to understand the difference between active and passive investing. Both can be an important part of your portfolio. You hear a lot about how active has not outperformed passive over time. Year to date, it has looked a lot better on the equity side than in the past. Historically, bonds have pretty consistently outperformed on the active side over passive investing. Year to date, active has been looking a lot better in the large cap space than it has in the previous years. One area to highlight is in intermediate core and intermediate core plus bond investing. This is where active investing has consistently outperformed passive investing. And it highlights the importance of being selective when choosing your active versus passive strategies. As a final takeaway, markets continue to move fast and headlines can be noisy. Staying diversified, understanding the big picture, and keeping a long-term mindset is very important. If you have any questions or want to talk specifically about what this means for you, don't hesitate to reach out to our team at THG Retirement Solutions. We are here to help. Thank you for tuning in, and we'll see you next month.